Good afternoon, everybody, and thank you very much to all those that have tuned in to today's webinar. Great to see so many familiar faces and also many new people on board. My name is Chris Bridges, Head of Sales at PFP, and I'm joined today by Andrew Stanley, Managing Director of Stanley Tax Associates. The relationship with PFP and STax has been going on for just over 4 years now. And Andrew and his team are experts in the field of property tax, specifically capital allowances. And today we're hoping to give you an update on capital allowances, the what's, the hows, the wheres, and the needs of. It is similar to a webinar we ran at the beginning end of the year, but we had a really positive and popular response. So we're running another one now, and now is actually a really good time of year to really have a good think about your clients and capital allowances as well. With year-end looming and also self-assessment approaching. So, Andrew, welcome today. Great to see you.
Thanks, Chris. Yeah, good to be here. Thanks for the introduction. As Chris said today, we're going to be having a bit of a look at our area of capital allowances, which is effectively capital allowances related to fixtures in different types of structures and property. We're going to start off by having a bit of a run through the background of what do we mean by capital allowances for fixtures, how do we go about tapping into this value, and to be blunt, why any of us, yourself or your clients, should be concerned about this. There was some new legislation. I call it new legislation. It was from Finance Act 2012. It has a huge impact on when a building changes hands, which if you get on the wrong side of, clients potentially can have a clawback of past given relief, crystallizing snap and unexpected tax charges. So not an outcome that anybody wants. As I mentioned, I still refer to it as a new legislation. It's 7 years old now, making it 2 years older than my daughter, who's just started school. But still, to a lot of firms out there, because of obviously the raft of changes everybody has to contend with, and certainly the conveyancing community, it still is new to them. So we're going to have a bit of a look at the details and the dangers and opportunities this throws up, and the sort of strategies we can deploy to overcome these. And we'll look at a couple of case studies to illustrate some of the different approaches that we put forward when coaching our clients through a conveyance, either buying or selling. We're going to take a few minutes then at the end just to have a quick look at whose duty of care it is, because if you get the new legislation wrong, or there's no advice given at all, then there is a potential for financial loss. And this ever litigious world, unfortunately, some of our clients obviously they'll be advised on capital allowances, but some of the clients out there in this world will be looking for who it was who didn't advise them correctly. So it's worth taking a couple of minutes, just having a bit of a look at the duty of care and what practical things you can do as a general practice firm to protect yourself from being on the wrong side of that. We're going to run through this all pretty quickly. A couple of reasons. One, to leave plenty of time for questions at the end, but two, I've never heard anybody complain a webinar about tax was too short. So, capital allowances in general. Well, not really going to dwell on this, as I'm sure you guys know. It's a form of tax relief available on some of your capital expenditure. To the man in the street, the tax allowed form of depreciation. You have two capital allowance pools with different writing down allowances, the main pool and the special rate pool. Of course, the special rate pool is special for HMRC, not for taxpayers, because you get a much slower burn on that. You get a certain percentage each year, balance carries into next year, and so on. Just going to mention the annual investment allowance. Again, I'm sure it's something you guys are very much aware of. At the moment, it's currently sitting at £1 million. So that slide needs a bit of an update there, Chris, but it is currently at £1 million, which means in this current calendar year, the first £1 million of spend, you can actually accelerate through 100%. Since we had the change from the old Brown administration to the coalition, it has been 25,000, 50,000, 100,000, 200,000, 250,000, £500,000, and now £1 million, and not in that order, and not changing every time at the beginning and end of the tax year. So there's nothing like consistency in tax legislation to allow businesses to plan for the future. But what this does mean is tapping into value and acquisitions made this year is even more exciting for your clients, because of course, unless they are buying very large assets, they're going to be able to write off all the relief straight away. So what can you claim capital allowances on? Well, in essence, it's a plant and machinery relief. The identification of machinery has never really caused much in the way of an issue. It is a apparatus with moving components that affects change or movement. For example, the tractor, clearly a piece of machinery. A machine, in a factory, as the name would suggest, is a piece of machinery. However, what is or isn't plant is a very different animal. And that's because there is no statutory definition of what is or isn't plant. And the closest we have is that it is negatively defined as not being the raw structure of a building and not being your trading stock. And that actually comes from a piece of case law from the late 19th century linked to employment liability and horse. Because of this, there is potentially an infinite number of items it can be, and therefore we have 125 years of a case law to contend with in this area. So there are items that we know are and items we know that aren't, and there's a lot in between those 2 points.
I think that's a really good point there, Andrew. Something that we come across a lot is a lot of accountants saying, yes, you know, we do a lot of capital allowance work, we claim it, but it's that grey area where an expert is really needed, I think, isn't it, to step in and help, because no practicing accountant out there will go through 100+ years of case law.
Yeah.
For what is what.
Yeah, and it's always very dangerous to apply any sort of logic to tax legislation and the case law at any point. And there are some decisions out there that may seem contradictory to the man in the streets, and also the way the asset's used, the type of trade they're in, and even the micro-location of the building can make a big difference as to whether something is eligible for capital allowances or not. So yeah, there's certainly an amount out there that the most professionals in our field will be aware of, but there's a lot more around the edge where we can add value. So fixtures, well, fixtures are the area that we're concerned with here. Obviously, loose items are plant. You'll see invoices at the end of the year, and I'm pretty comfortable that most of you guys will be on track just to add them up and put them into the relevant pools. So what are fixtures? Well, fixtures, as the name suggests, are items that are fixed to a building. So if you nail it, screw it, glue it, embed it so that it becomes part of the structure of the building, it is treated as having become part of that building. And therefore, different sets of rules apply to those for loose items of plant. So just to kind of close this point off, as you can see, there's a transit van there on the screen. This is not fixed to a building unless you drive it very badly, and therefore is not a fixture. Whereas the fire system 4000, a particularly nice fire alarm in a building we surveyed many years ago now, is a fixture. Most of the items you can see in this image are fixtures. You know, you've got the hand dryers, you've got the disabled grab rails, you've got the sanitary ware and so forth. Within fixtures, we have a subcategory called integral features, born back in April 2008. This is effectively just a handle for special rate pool fixtures. And this tends to be, well, it is predominantly the utility infrastructure in the building. So things like the electrics, plumbing, heating, air conditioning, lifts, all items which HMRC believes will live for 25 years or more. Not sure I want to be going up and down in a 25-year-old lift. So they go in the special rate pool, which means you get a slower rate of relief on them. One point just to note with this is that the introduction of this back in Finance Act FA08 was deemed to be tax neutral. And to achieve this, they brought several classifications that previously could not be claimed for capital allowances, such as the cold water systems, electrical distribution and lighting, brought them into eligibility, but at the same time balanced that by taking several main pool items, such as the heating or lifts and air conditioning, and bringing them down into the special rate pool. So this is important when we look at the changes from FA12, because they are only binding on items which vendors can add to a capital allowance pool. So in some instances, if their expenditure predates this change in 2008, there will be certain items that they can't. So I think I've explained that quite badly for a Friday afternoon. I will come back to that a bit later on, but just remember April 2008 as a key date for now. One last image here. You can see a hallway in a hotel that we surveyed many years ago. In leisure-orientated industries, predominantly, decorative items play a business critical function. They create the ambiance, which generally justifies the room rates, attracts customers, and makes them come back again and again. So in these sorts of businesses, a wider range of decorative items are eligible for capital allowances. A bit of relevant case law there for you guys who want to read up a bit more. The Wimpy case a few years later also covered the same point. So just before we move on, you can see a loading bay here of a industrial unit we surveyed many years ago now. The green arrows are indicating loose items of plant and machinery perfectly eligible for capital allowances. They have not fixed the building and therefore not something that you generally need specialist input on, and also not something that the FA12 changes have any bearing on at all. What it does have a bearing on are things like the mechanical parts of the moving shutter, the electrics on the wall, the vinyl curtain and its runner, the signage, and a whole host of items you cannot see here because they are on the walls, the floors, and so forth. And what this means is that most businesses are tapping into the tip of the iceberg, whereas the majority is remaining hidden from view under the water.
I think, Andrew, a really good analogy you mentioned to me many years ago is if you take a building, you shake it upside down, it's all the stuff that wouldn't fall out. That's the stuff that's hidden underneath the skin, as it were.
Yeah. And to be able to assess the value on these, you need to know what sort of systems are there in the wall supporting the items you can see. Surprise, surprise, our clients would be unhappy if we started drilling into the floor of their offices and knocking down walls just to check there was a certain amount of pipes or wires there. But I would just make the point, the situation illustrated by this iceberg is no negative reflection on firms in general practice. Okay, the items in the building will have got there one of two ways: either by a period of works or a building project being undertaken, in which case the firm, the general practice accountant will see the invoices. I'm sure will add some items to the capital allowance pool, but the bulk of the value will be hidden in ambiguous invoices from contractors. And unfortunately, the records you tend to get from building projects do leave a bit to be desired. And therefore, tapping into and identifying all the relevant expenditure, allocating professional fees, labour costs accurately, requires just as much quantity surveying input as it does tax. And it's an unusual firm that combines these two. And that's why obviously there's firms like us that exist in the first place. Also, when you buy a building, part of your purchase price is perfectly eligible to be claimed and added to the capital allowance pool for the items that were in place at that time. However, your expenditure is the purchase price, which will generally bear no direct correlation to the sum of the components that make up the building. So even if you were a quantity surveyor and you could go in there and value the items, that's not the amount that you can claim. What we have to do is go in there and effectively calculate the relative ratio in cost between the items you can and items you can't. So this is it's called an apportionment. So imagine this pie chart you can see represents the full reinstatement cost of the building. We will go in there and we will value everything from the foundations through to the roof, down to the level of detail of type, make of door handles. From this huge spreadsheet that will come from my survey team, we can then identify all the items that are eligible for capital allowances. So let's imagine that's 25% of the total. But then, left of all the items that aren't eligible for capital allowances, so walls, floors, ceilings, doors, and so on, and because we now know how much it costs to build the building, we can find out for comparables in the marketplace or even direct data from that property what it would rent for. We can calculate from there what a commercial entity would buy the site to build that building on. Imagine that's 40% of the total. We can now multiply through the percentage that relates to the plant and machinery by the amount of capital consideration actually incurred when you bought the building. So if that was £1 million all in, you'd be adding £250,000 over capital allowances to your capital allowance pools, which of course is £47,500 at 19% corporation tax, or over £112,000 at 45% income tax. So that's over 11% cash back on the purchase for claiming a relief that you're perfectly entitled to on money that your client was going to spend anyway. Now, of course, there's a bit more to it. What happens in the conveyance and the history can have an impact on what you can and can't claim, but that's the basic model. And there's a lot of relief on the table to be tapped into. One side point, just because it comes up in almost every presentation and webinar that I give, is that there's a bit of misconception out there that all you're doing is robbing future Peter to pay today Paul. By claiming this 250's worth of capital allowances, have we just reduced our base cost to 750, and therefore we're just going to pay more on capital or chargeable gains further down the road? Fortunately, that's not the case. claiming and on the fixtures in a building does not change your base cost for your gain calculation. The only correlation is if you sell the building at a loss, and therefore your allowable loss is restricted by the amount of capital allowances you claim.
That's pretty good, Andrew. Already had a question similar to that come through. I should have mentioned at the beginning, everyone, that please do send your questions through. We've already had quite a few come through. We'll answer as many as we can in our allotted time of 45 minutes. Any we can't, we'll answer at the end. But just a quick question here, and just reverting back to AIA at the beginning, the annual investment allowance from Paul. Can you claim AIA on second-hand assets?
Yes, yeah, potentially. A lot of our work with second-hand buildings, we have to obviously look at the history and see what previous owners have or haven't done, what was agreed in the conveyance. If you were buying loose plant second-hand, then there's no restrictions on using the AIA on that. So, what sort of structures can you tap into this relief on? Well, in the eyes of the Capital Allowances Act, all buildings are eligible, but then there's an exclusion for dwelling houses. HMRC accept that a building can comprise multiple dwelling houses. So this means that we can do this on all forms of commercial use, from zoos to dockyards, farms to office blocks. In the residential sector, we can look at furnished holiday lets, which are becoming very popular at the moment. And that effectively changes in many ways the treatment of the building from being a straight resi to a commercial property. And we can look at the true communal space in a multi-unit residential property. So by this, I mean, if you've got a block of 8 apartments, we can look at the plant and machinery that's in the hallways, the lifts, reception, gym in the basement, car park, and so on. Despite what some of our less reputable competitors might say, we don't see this as extending to kitchens in 3-bedroom student houses and so on. Timing and viability. We are lucky in that there is no statutory limit on how far back in time we can look. So you could have bought a building 30 years ago, and we can look to claim against the cost back then in the more recent periods. There's an interesting bit of case law we've done this recently, which does potentially open up the door to go back further than the amendment window. One point on viability, though, is that even though we can look back 30 years, we are driven by cost, not by value. So if you go back too far, of course, it starts to become a bit of a moot point because you're claiming a fraction of a very small number. And at the same time, having to trace back a very, very long history to get the building back to the state it was at purchase.
A couple of questions we just had in on that topic, actually, Andrew. One that comes from Jill, thanks. Can you claim back on previous years? I think you just covered that there, Andrew.
Yes, indeed.
On that. Another one is, Chris mentioned it's a good time of year. Why is that?
Well, at this time of year, obviously everybody's getting ready for January madness in general practice. Fortunately, here as a specialist niche firm, we don't do any normal accounting work, so we don't have to submit any tax returns or so on. However, we are driven by the same cycle as well, because the standard approach with a historic claim is to start the claim as far back in history as possible, so you can get as many WDAs. So up until the closure of the amendment window, which runs to 1 year after the filing deadline, you can actually then go back effectively 2 years. So to give you an example, for personal tax coming up for income tax, for the 31st of January, up until the 31st of January, we can actually go back to year ended 18, start the claim from there. Clients get a tax rebate for the tax they paid last January, and then also straight away reduced tax to pay for the end of that January. And then of course the balance carries forward into later years. Now come the 1st of February, we can still do the work, but you can only go back 1 less year. And even though it all comes out the wash in the end, from our experience and probably yours, people prefer Jan today rather than Jan tomorrow. We've got exactly the same situation with December year-end limited companies as well. So it's a great time of year to look at this, because there's still plenty of time to get the work done. Everything's submitted with the returns. It just means that your clients are able to get 2 sets of rebates straight off the bat rather than 1.
Geez, Andrew.
So what sort of process do we go through? Well, unfortunately, it's not an overnight process in our sector. To be able to, to look at making a claim on a building, you need to validate, if you have the legal entitlement to do so, which is predominantly looking at the history going back to 1996. Seemed like a reasonable horizon when the Capital Allowances Act was rewritten in 2001. We are still tracing the history all the way back to 1996. We need to speak to the tenants, the solicitors who handle the conveyance, yourselves as the accountants, the particular taxpayer, to find out what happened when the building changed hands, what happened since, and so on. All that being well, and there not being too much in the way of any sort of restrictions, and we can justify making a claim, we'll move on to survey the building. We'll then analyse that data and then issue it in a report to you and to your client. Shows you what we found, where we found it, photographic survey, floor plan, description of the building, supporting calculations. This is to show the client, obviously, what they're paying us for. So you guys can then take our findings, from the executive summary and lift them and put them into the actual tax returns. And it's then designed to be attached to that and sent to HMRC as a supporting document with the first return that affects the claim. We don't take a 64-8 authority, and for a great way to all fall out. I think you have enough headaches with that system without us complicating it any further. The reason for sending the report on to HMRC is they can see where the reliefs come from, and also they can see it's us. It means if they have questions, they can ask them there and then, and they're limited to the 1-year inquiry window. So average 2 to 3 month process. This time of year, we're geared up to do quite a lot of evenings and weekend work to get things done for December and January.
That process time there, I had a question came in from Dawn. What's the process and how long does it take? You've just been through the process, and I think, as you said, it's all hands to the pumps now between now and year end for you and the team here, Andrew, saying.
Yeah, we do shut between Christmas and New Year to stop everybody having some sort of nervous breakdowns. But there's a lot of holiday booked for February, let's put it that way. I'm sure it's the same for a lot of you guys out there as well. You can try and actively manage your clients to bring in their records early, but there's always a certain percentage who will dump them on you 29th of January and expect you to perform miracles. So why would your clients be interested in this? Well, there's a whole lot of bullet points there. I'm not in the belief that I should sit here and read out bullet points when giving a webinar. I'm guessing all of you guys are able to read, or you're going to find it difficult to qualify as accountants. The bottom line is that it's all about money. If you're a successful business, one of your biggest costs is going to be tax, and anything you can do that's non-contentious to reduce that, you'd be balmy not to. And so for the small number of your clients who do own or are buying buildings, because most of them will rent on relatively short terms, then this is extremely relevant. But why should you, in general practice, be fussed about this? Well, I speak to a lot of firms, and I'm sure you're all aware of this, but there's a situation in the world of general practice where the likes of Zero, cash flow, these sorts of guys are pretty much ripping the guts out of the value of a lot of the basic compliance work. There's a proportion of the market out there who are ignoring this and are dragged into some sort of kind of terminal race to the bottom for fees. Some firms are setting up as factory firms, to file 1,000 contractor accounts a minute or whatever they're doing. Most firms who are looking to stay out of this are bringing in more value-added services to become more, position themselves as a more of a kind of a one-stop shop business advisory service as accountants, rather than just people who do the basic figures. Capital allowances, for those of you, for those of your clients that are relevant to this, it's a great way to build bridges. If we work for one of them, or you just advise them in this area, and they save on their tax, people tend to be quite happy with that, and it allows to give you a bit of a competitive edge over accountants who aren't, and of course stay out of this race to the bottom. We do pay a small referral fee to compensate our partners for the investment of their time. And of course, you're avoiding the other side of it. If you're not advising in this area or making provision for advice, people run the risk of being at non-compliance with the legislation we'll look at in a minute. Certainly, you're not going to make any friends doing that. You might lose clients, and you might even face a negligence claim. The unfortunate reality now, since it's changed, is it's a carrot and a stick scenario. And the awareness is much higher. And the likelihood is if people are buying commercial buildings, they're going to hear about this at some point from somebody. And personally, if I was back in general practice, I'd rather they heard about it from me sooner rather than somebody else later.
I think there's a poll that the Sunday Times run every year, Andrew, and I think for the last 8 years in a row now that accountants have come up in top spot with the most trusted business advisor out there.
Yeah, I'm not surprised. There's as an industry, generally everybody has quite a high level of integrity. We do a lot of work for the legal profession and commercial property as well. And yeah, you see the contrast.
The legal profession rated below estate agents, actually. So there we go. Gives you a reflection of how well you thought of it there. A couple of quick questions, Andy, if that's okay. We've had loads come through. So, question from David Guest. Thanks for the question, David. David's the treasurer of a housing association that owns various blocks of flats. Lots of them have common communal areas. Would they be able to claim capital allowances there?
From a capital allowance perspective, you have to have what's called the two Qs in place: qualifying expenditure, which you undoubtedly have, but also qualifying activity. And in a lot of instances, the not-for-profit nature of housing associations can cause issues with that, and it can become under the effect of uncommercial letting, so there might be restrictions there. But the devil's always in the details of these sorts of things. So it's probably worth us having a chat.
We'll have a follow-up afterwards, David. We'll get in touch on that. Another question that came from Mr. Bradshaw: if someone backs out of a HP agreement before it ends, having claimed capital allowances on the asset, what would happen then? That's maybe one for a bit more detail, because I imagine there's lots of finer points to that.
Indeed, it's a little bit outside, obviously, what we're looking at here with buildings as well. So I think it's probably worth having a chat there on the phone about that.
We'll follow up with both of those after. Thanks, both.
Brilliant. So, just moving on, and apologies if we're covering old ground there for anybody, but that's the crux of what we mean when we talk about capital allowances related to buildings and why we should be concerned about this. The new legislation, brought in FA 12, now written into the Capital Allowances Act as Section 187A and 187B. They're in all its glory if anybody wants to have a bit of a read through. I don't think legislation.gov.uk has updated it yet, but then again, they tend to be about a decade behind reality. The new legislation only has a bearing when a building changes hands. So let's have a bit of a look at what's supposed to happen when a qualifying asset is bought or sold. So imagine you've got an industrial unit. Let's say you bought it for £1 million 10 years ago. You spoke to us a few years back. We added 250 to the capital allowance. Just imagine single pool system for the example. I should also say 250 is very high for an industrial unit. You've used a writing down allowances, and today you have a tax written down value in the pool of 100,000. You decide to sell the building onto this chap here. And what's supposed to happen is that the parties have a commercial discussion and fix an effective transfer value by a joint election called a Section 198, which I'm sure some of you have had forwarded to you by clients and solicitors and so on, or may even have completed yourselves. Now, the value on the Section 198 can be anywhere from £1 per capital allowance pool, so in this example £1, but in reality £2, right up to the total amount that's ever been added to the pool on fixtures that are still in the building. So in this example, that's anywhere between 1 to £250,000. So what sort of impact does this have? Well, it's a straight seesaw between the parties. So looking at a couple of key values here, I think is the best way to illustrate this. So if it's at 250, you have an addition for the purchaser, or plus 250, so they'll be very happy. At the moment, they can write the whole lot off using the AIA. You have to then bring a disposal charge of minus 250 against the pool balance of 100. So keeping the maths nice and simple for this time on a Friday afternoon, that would then drive you into a negative 150, which actually has the opposite effect of what you want. It means you have a balancing charge to the taxable profits. So you would then pay tax on that effectively notional profit of 150. So not a great outcome for the vendor unless you've got a whole load of losses to absorb that. If it was 100K, it would take all the residual balance from the vendor and give it to the purchaser. A lot of people say this is a fair value. This is a commercial transaction. I don't think fair comes into it. Depends who's in the driving seat, what's the structure of the deal, who's getting the best advice, and so on. A lot of deals are agreed at the tax written down value, because that means the purchaser gets an amount of relief and the vendor doesn't tend to crystallize any sort of hard cash cost. If it was at £1, the purchaser gets £1 and the vendor keeps £99,999 worth of relief on items they don't even own anymore. Which some people say this, well, how can HMRC accept this? This seems abuses. Well, HMRC, it doesn't really bother them. This is jam here to jam there. It's the same amount of jam in the system. And that's why these elections exist in the first place, because only one party is ever supposed to claim the full value. So the elections are supposed to regulate the flow of relief down the chain. So either all, some or none is shunted down to other owners. Unfortunately, in the past, the most common election you would see was one that doesn't exist at all. And because of this, Mr. Osborne felt that people were double claiming. As you can see, he's not very happy about it there. So he set about doing something about it. And the new legislation was born. The more cynically minded will remember that Deloitte's Capital Allowance team did a study back in 2011 that said that the latent claim in this area is £82 billion. And that may have been a small motivating factor for Mr. Osborne to do something. So, whatever the motivation, it's here now. Part of it kicked in April 2012, the other part April 2014. The two bits you need to be concerned about are A and B there on the list. I would just say every tax presentation needs a horrific bullet point slide, and here is mine.
I've seen worse, Andrew, so it's not looking too bad.
So you've got the mandatory pooling requirement and the fixed value requirement. As I said, staggered starting for mandatory pooling, but they're both in effect now. So if you buy or sell a building, you need to be concerned about these. So the two work in sequence. Mandatory pooling states that anything the vendor is entitled to add to a capital allowance pool, they have to add to a capital allowance pool in a period up to before sale, so effectively up to 2 years afterwards. So we're working on yesterday's homework in tax. If they don't, nobody else ever can. So it's just gone forever. And then on everything that has been added to a capital allowance pool, even if it's written down to zero now, you need to fix an effective transfer value either by a Section 198 or by decision in the tribunal to comply with the fixed value requirement. And if you don't, then both parties get the worst possible outcome. The vendor still needs to bring into account a disposal charge, which under the corresponding part of the table on Section 196 is market value of items in place at the time. Well, it's actually the value that would have been attributable to the purchaser, but in a rising market, that's always going to be limited to what was claimed. So that will be that horrific 150 balancing charge, and the purchaser doesn't even get £1. They get absolutely nothing, binding on all future owners as well. So they've just made their building worth that little bit less. Anybody wanting to buy it from them later. And of course, I just put some numbers on here. So you're talking 250K's worth of relief going out against a pool balance of 100. So you've lost the residual pool balance, and you've just crystallised either near on £30,000 worth of corporation tax or pushing on £70,000 of income tax for not having put in place a one-page election. Probably not a very happy client there. Purchaser gets absolutely nothing and devalues their property. And of course, HMRC takes £250,000 worth of relief out of the system and potentially nets a nice chunk of corporation tax at the same time. So back then, old Mr. Osborne was looking a bit happier, as you can see. Net Treasury projections were this would net £35 million net benefit a year. I think that's quite low. There's no hard and fast figures out there. And the smaller end of the market, a lot of buildings are changing hands with almost no advice at all, and they're just dropping off the radar for good.
Quick questions come in through from Jason Andrews. Client of mine purchased a property around about 9 months ago.
Mm-hmm.
Is it possible to still claim allowances, or are they now lost forever?
The short answer is possibly. It's better to get advice now before exchange of contracts. There's a couple of things that might help your client out here. Firstly, if they're lucky, they would have bought from a non-taxed entity or some other business who was unable to claim their capital allowance, say a property developer holding its trading stock. Because the mandatory pooling only has a bearing on items that they are actually legally entitled to add to a capital allowance pool. So they have no entitlement to that. Then chances are, it depends obviously when they bought the building, that you don't have to comply with mandatory pooling, and therefore there is nothing to apply the fixed value requirement to. Also, there's a 2-year compliance window from the date of completion in most instances, in which to get your Section 198 election to HMRC. So within that time period, there is potentially a win-win path that can be tread between the parties, because the vendor can't claim the relief without closing off their history by an election, and the purchaser can't claim the relief without getting the vendor to claim it and transfer it. And after 2 years, of course, they both can't claim the relief. So up until that point, there is possibly something that can be negotiated between them. So we spend quite a bit of our time going back, finding out who was the previous owner of the building, contacting them and negotiating some form of settlement between the parties, be it a division of the relief, or in some instances where you've got administrators who of course don't want tax relief, some sort of cash for allowances deal. So the short answer is yes. Certainly, my point I want us to look at sooner rather than later, because as time goes on, And the further back in people's minds the actual transaction was, the more difficult it is to get people engaged in the process.
Not all is lost.
No, it's never say never. A couple of other things just around the requirements as well. If you're selling the building, Section 198 election is a must. Reason being, if you don't, then the purchaser, or to the vendor you can, but this would be like turkeys voting for Christmas, you can refer it to the tribunal. The tribunal will fix the value, and that's generally very good news for the purchaser and very bad news for the vendor. When I'm sitting in people's boardrooms talking about this, you can see quite often on people's faces, they're thinking, well, some of our clients own buildings, but we haven't really done any sort of, full reviews, big claims on acquisition costs and so on. So we don't need to be concerned about this. I don't think that's correct, because I think it's a very rare property that hasn't added anything to a capital allowance pool for fixtures. It might just be that new air conditioning system that was installed 4 years ago. When you saw that invoice of £50,000 worth of air conditioning from Air Conditioning for You or whatever it might be, that probably found its way into the capital allowance pool. So if you're not closing off the history, even just on that little bit with an election, either the purchaser can refer it to the tribunal and get the whole lot clawed back and given to them, or 2 years down the line, HMRC might come knocking and saying, well, can we see you've brought into account your disposal value? So it's a very dangerous bit of legislation to ignore. Even if you're not going for the whole, the whole benefit, there's generally an element of risk in almost every single transaction that happens. So, quick checklist for you. If you get a call from a client of yours saying they're looking at buying or selling a building, which would be nice, rather than phoning you 6 months after the fact and saying, I bought a building 6 months ago, what's your advice? Is legislation in effect? Who are they buying from? Is it a pension? Is it, is it the council or someone along these lines? Have allowances been claimed? There's what's called the CPSCs, Commercial Property Standard Inquiries, which sometimes you get some useful information in when you're buying a building. Often you just get a whole load of non-applicables, but they may indicate what the previous person has or haven't done. Have you already agreed to an effective value? If you're buying at auction, you'll generally agree to terms before you put your hand up, and that may bind you a little bit to what you can and can't do. Who's in the driving seat? Will they cooperate? If you're buying, we see this with the major breweries who are selling off a lot of their pubs. They'll put forward a position. We'll try and change their minds, and they'll say no. You either accept this and buy the pub, or don't. That being said, we'd always try. What did the vendor pay for the building? Seems like a funny one. If your client's buying the building, it's always worth getting your hands on the title document, seeing how far back does the vendor's history go. 2 reasons. This one, if it goes back to the early 50s, there may not be much point talking about putting claim and transfer clauses in, getting them to pool a percentage of the purchase price in the 50s, and then sending you 5 and 6 in old money on a Section 198. But also means there might be some items you can claim because their purchase price predates that 2008 date we mentioned earlier. So, conscious of time, that covers off the overview of the changes. It's a huge subject, and there's no standard strategy to deal with it. Every bit of advice we give is bespoke and tailored to the actual transaction. Got a couple of case studies I'm going to blitz through here, because I've gone on a bit longer than I should have done, just to illustrate the kind of common strategies we're putting forwards, and the kind of things that are possible now to work with the changes. So all these are post 2014, so both mandatory reporting and fixed value requirement in place. A client of ours bought a hotel in Kendal for they were buying it for 1.6 million when we first spoke to them. Previous owners had paid 1.2 million. The CPSCs, Commercial Property Standard Inquiries, came back with a whole lot of question marks and smiley faces on, indicated they had no idea what the questions even meant. I think the first one, which says, is it held as a fixed or current asset, said neither. That normally is a sign that someone's been very, very well advised. So what do? Well, we put forward clauses, example clauses, because we're not solicitors. We put forward clauses to the conveyancers that they were then inspired by to write clauses for the sale and purchase agreement. In essence, said that the vendor would add everything we found to the capital allowance pool and then sign it across in its entirety by joint election. We actually do the work after the completion's gone through, because nobody wants a 2-3 month delay to their conveyance. It also means that we can keep any numbers out of the terms as well, because unsurprisingly, if you say to somebody that we think there's £500,000 of a tax relief here that you're going to send to us, they tend to see it differently. So the vendor in this instance agreed because they wanted to sell the hotel. So we went in there, surveyed it. We found £320,000 worth of new pool additions that they added to the capital allowance pool and then transferred to our client. And we also found a further £64,000 of what we call the pre-commencement integral features, or an overages claim, as some people refer to it, which are those items they couldn't have claimed because their purchase price or their expenditure predated the 2008 change. No disruption to the conveyance, because all the work happens after it's gone through. And of course, the client's very impressed with their accountants for making a timely introduction.
Very quick question on hotels. Sharon just sent in a quick question. Can capital allowances be claimed on a small hotel where the purchaser also lives?
Potentially, yes. There are very bespoke bits of legislation around staff accommodation, linked to whether they have separate street entrances and so forth. So there's a very good chance to claim on the whole building, obviously subject to review of the history, the conveyance, and so on.
We'll get in touch with a bit more information afterwards.
Yeah, brilliant. So as I said, the bottom line is it takes two to tango with this now. So if your client is buying or selling a building, just ignoring it, brushing under the carpet, hoping you can deal with it later, is not normally the best strategy. Next case study to illustrate that we can sometimes go back and repair a scenario after the event. 3 clients of ours owned a block of FHLs in Torquay. They had claimed some allowances on fixtures, rather interesting methodology, but nevertheless it found its way into the capital allowance pool. They had sold all the apartments when they came to us via the internet. They literally Googled around about capital allowances and found us. So it's after the fact they hadn't put any clauses in the sale and purchase agreement linked to capital allowances. So they were exposed to either any one of the purchasers getting wise to the fact they can refer to the tribunal, or to HMRC coming and taking that 270 back from them. So what do? Well, we approached all the new owners and said, look, our clients overlooked this, you've overlooked this. What we propose to do is to come in, survey the building. We'll transfer you half of what we find by a joint election. Our client gets to keep half. And of course, they agreed once we explained what the hell capital allowances were, because it was a large collection of private investors who, for some of them, this was their first investment outside their main home. So a long couple of weeks' work for us. But of course, for them, it's just money from the sky. You know, it's just tax relief from nowhere. We went in, surveyed all the apartments, closed off income tax risk for our clients of just over £100,000 in actual cash, and delivered further income tax savings on the amount above. The client wasn't that impressed, obviously, the advisors who failed to flag this up for many years, and to be honest, actually quite obstructive during the work. But the bottom line is that post-completion, we can often go back and repair a scenario, but you need to make it interesting for other parties to work with you, because you generally need some form of financial motivation. But it's better to get half of a cake than a big slice of nothing. This last case study is just second last case study, just quickly to illustrate that the new legislation is not always in effect. A client of ours, major separate investment fund, had a large number of quite substantial assets across the City of London and the West End. One of them was the headquarters of a major bank. They bought for £33 million, referred to us by their accountants. Generally speaking, the larger the transaction, the landowner, the more likelihood that either they or someone in the history has squeezed every drop out of the building already. But we should never say never, because in this particular instance, they bought it from a pension fund, who bought it from a pension fund, who bought it from a pension fund, who bought it from a pension fund. So it's pension funds all the way down, which meant barring some pretty hefty tenant adjustments for their installations, we were able to make an unrestricted claim because the mandatory pooling and fixed value requirement were not in place. It was actually a claim of £8.7 million worth of new pool additions, which, as we charge as a percentage of the new pool additions, was a very nice end of the year for them and us. That particular accountant, who's a bit more, proactive than others, is going around different networking events within the North London Cypriot community and using sanitized versions of our findings to try and kind of poach clients from his direct competitors. Obviously, you'd be slightly more subtle about than him. But the bottom line, the reason why we use this example is two points really. Never say never with the size of clients. Of course, the larger they are from assets on the balance sheet, the more likelihood they have already taken advice. But we've worked with some major PLCs that really should have spoken to the auditors a bit more. And also, new legislation is not always in effect. So it's always worth, just having a bit of a look. We're always happy if we get addresses just sent in. We can find out, we can get the title documents, we can see who the past owners were, even if it's past the 2 years. It's always worth having a quick look, because you never know, there might be a silver lining there that opens up the door to at least claiming some relief. And the last example, case study here is, if you take nothing else away from today, make some notes on this. This is what you don't want to do. This is the worst way you could approach a property transaction. Client of ours bought a care home for £5 million. The vendor's solicitors sent a report compiled by Deloitte. The vendor was a large care home group. When they built the care home, Deloitte came in and calculated what was available, £1.3 million of the capital allowances on the build costs. They then proceeded to not talk about capital allowances again during the whole conveyance. So we told our client, play dumb, stay quiet, and we will deal with this afterwards. And we went in afterwards and surveyed the building, referred it to the tribunal. The tribunal's view is you've got somebody who's just sold these items at a profit and somebody who's just made new qualifying expenditure on them. So the tribunal generally very good news for purchasers, very bad news for vendors. We then get contacted by their new auditors, PricewaterhouseCoopers. They said PwC about 15 times in the first minute. I think they expect us to scream and fall off our chair. We didn't. We rejected their opening offer of 400K's worth of capital allowances. We then stuck to our guns, and eventually we did agree a settle of £1.17 million worth of relief being transferred by Section 198. Our client felt it's better to take a small chip on the total amount we might get, just because anybody who's been involved with the tribunal will know it's not an overnight process, and there's no certainty with legal action as well. So, cost of not putting a one-page Section 190 election in place was £234,000 in corporation tax. Wow. So quite an expensive blunder. We then, after we finished the instruction to our client, phoned up the care home group and said, would you like our help bringing a negligence claim against your conveyancers? And they said, there's no need, we are already doing it. So the bottom line is, not knowing the legislation can be very costly indeed. So literally 2 minutes on duty of care. Who's going to take a tumble on the banana skin? Two cases here on the screen. I'm sure most of you will be aware of the second one, but Clark versus Ilsbooth Bennett. Mr. Clark selling his business, Ilsbooth Bennett solicitors failed to advise sufficiently on certain tax indemnities in the contract, and he ended up paying a lot more capital gains than he felt he needed to. He brought a negligence claim against them for the extra cost. They tried to defend themselves, saying, well, hey, we're solicitors, we don't give tax advice. Look, it's written here in our care letter. The judge didn't see it that way, and they said, if you put yourself out as an expert in a field, and tax indemnities are part of an instruction, you have a duty of care to understand them. Not surprising, really. It's a bit like us putting forward capital allowance advice and saying we don't take any liability for capital allowance advice. It just wouldn't stand up. So, Mr. Clark won. Mayhew versus Harbin Barker. Well, firstly, obviously with Clark, that means the duty of care, where there's the CPSEs there with a capital allowance section, I think personally is slap bang on the conveyancer's desk. Unfortunately, our cousins in the legal profession are not, they're not daft when it comes to matters of liability. And when they get to these points of the conveyance, what do? They say, this is very important. You need to speak to your accountants. And of course, they phone you up, and what you say at that point can make a big difference as to whether you take the liability or not. Mayhew just reiterates the point. He did actually lose an appeal, but Mr. Mayhew originally sued Harbin Barker Accountants for not having introduced him to the correct tax avoidance company. Yes, you heard me right. It was Montpellier, who I don't think are around anymore, so I can say quite safely now, my experience, were always the wrong tax avoidance company to be introduced to. But it was overturned at appeal because it was seen that Harbin Barker didn't have the duty of care to understand the ins and outs of all tax avoidance schemes, or they would in fact be tax avoidance providers themselves. But it was reiterated that the judge saw that accountants have a duty of care to know when a scenario exceeds their capabilities, and to either say we are not giving advice or to bring in outside advisors. So this means that general practice, you are faced with a scenario which is summed up by this quote from a fictional character quite well, that the graveyard is full of middling swordsmen. Now, that doesn't mean they're hanging around in the graveyard. That means obviously a little bit of knowledge is a dangerous thing, and they are in the ground. So what does this mean in reality? Well, you have two options. One, you can invest a lot more than the 50 minutes a day in getting to grips with the ins and outs of legislation, the case law, bring on board some quantity surveyors, train them as well, set up all the processes, everything required to effectively launching the competition against us. Or you may have other things to do, such as quite a few tax returns in a couple of months' time, and you may wish to refer this on to a specialist like us, and we can take all of that headache and liability off your desk, and even generate a small amount of fees for you too.
Win-win.
So very quickly, we often find that firms say, well, how can I bring in an outside party, kind of the embarrassment factor. Well, this shouldn't really be a negative reflection on you. The tax regime is vast. No individual or firm can be master of all of it. We often pick up work from firms that are with Big Four auditors who do have departments to do what we do, but because they're so vast, nobody communicates internally and knows about it, and therefore it slips through the net. So there's no shame in saying, well, I don't understand to 110% of everything in the tax regime. Clients, surprise, surprise, don't tend to be unhappy if we reduce their tax. It tends to be quite a positive reaction from my experience. And general practice is quite literally what it says on the tin. You wouldn't go and see your medical GP, the pain in your chest, and expect them to crack you open and do a triple bypass there and then in the surgery. You'd expect to get referred to the specialist, the cardiac ward in the hospital. And tax is no different. Maybe Dr. Nick is not the most reassuring picture to have used there.
Possibly not.
Now, of course, there are other capital allowances advisors available. I wouldn't suggest you use them, but I'm potentially biased. But we do sit in a kind of a spectrum of quality of competitor. We've got some good firms we compete against, but unfortunately, we do have quite a few at one end of the spectrum who are making little teeny weeny claims on the basis that HMRC will never ever question them. And then, as seems to be endemic in all areas of tax, we do have some kind of cowboy-based operations making unfounded, inflated claims, ignoring things like the mandatory reporting and fixed value requirement on the basis that when the proverbial hits the fan, they won't be around to answer the questions. We feel that we sit in the middle of this. We have been coined the Goldilocks of capital allowances by a client of ours, in that we're not too hot, we're not too cold. We are here to maximize the benefit to our clients, your clients, but we're not going to put forward anything we are not 100% happy having a chat with HMRC about. All of our reports are sent to HMRC. Everything is completely transparent on the table. If they want to come and discuss the relative values of boilers and door handles, they are more than welcome to. And because of this, touch wood, we have seen the instance of inquiries that we've had over the years have gone down quite dramatically. So why use us? We're a professional firm, a mixture of qualified tax advisors, certified chartered accountants, chartered surveyors, and a whole host of other flavor accounting and surveying professionals. We're doing this for the best part of 10 years. We only charge on a performance basis, as a percentage of the new pool additions that we find and secure. No fixed fees, no upfront fees, everything's guaranteed on success, and any sort of HMRC questions are covered as well. Means as long as your clients are paying tax, and we will check this very early stage on, you'll be surprised, then it's mathematically impossible for them to be anything other than cash flow positive working with us. Track records, we've done literally thousands of buildings over the years. Not a single claim has been rejected. We've only had 2 reduced as an inquiry to date, and they won't reduce much. Final point, seems a bit weird. We do the work. We're not going to push back massive questionnaires onto you or to the client. There will be some information we have to gather, but we can get a lot from the public domain. We're the specialists in the field. We're the ones getting paid to do the work, so we're the ones who should be doing it, not just pushing it onto other parties. So if anything today has kind of struck a chord or you're interested in, there's many ways we can work with our partners. We're happy to obviously look at individual cases. Feel free to bombard us with addresses of buildings and scenarios. We're always happy to give you our opinion. We do, mainly with firms we work with a bit longer, do more wholesale client bank reviews where we can go through from A through to Z, identify those that are unable to benefit, those who are most likely to benefit, and also those that might have pending compliance cut-offs coming up soon. We spend a lot of our time guiding people through conveyance to ensure compliance. We can provide pro forma documents, draft Section 190 elections, and so forth. And pretty much anything that we can do to help you spread the words. We have the marketing team here writing newsletter content. We do bespoke flyers. We work in conjunction, as you know. Chris and the team at PFP are very good with the marketing elements as well. So if there's a particular thing that you think would be useful to spread the word to your clients, give us a call. I'm sure we can put something in place. So thank you very much for listening. I hope today we've given you enough background on capital allowances to see why they're highly relevant. Covered a bit about the new legislation, so you can see what sort of dangers and opportunities it throws up. And if nothing else, hopefully, the next time you get a call from a solicitor or a client saying, "Oh, I'm buying a building. What's your advice for capital allowances?" Maybe you just pause and think what your response should be. So,
thanks very much today, Andrew. Apologies for overrunning by almost 15 minutes there. We've had a number of questions come through. We don't have time to answer at the moment, unfortunately, but we'll follow all questions up with emails and phone calls this afternoon. If anything has struck a chord, then please do get in touch with us as well. Hope you enjoyed the webinar. Andrew, thank you very much.
No, thank you very much for listening.
Really good webinar again. And our next webinar is coming up, I believe, on the 20th of November, which will be looking at stamp duty and land tax and all things relative around that. So that's one to look out for, and hopefully see everybody soon. Thanks very much.